Thanks very much for letting me join and talking to you all about making tax digital. From my email, I did actually let you all know this isn't a technical one. I'm not an expert on accountancy. It's just I thought this was a really good introduction to talk about the things that could be happening with tax made digital and how it could have an impact on yourselves. So my agenda is going to be covering a couple of areas. Feel free to ask me any questions. I will try and answer them as best as I can. But what I wanted to run through is what is making tax digital at the moment? Why has it been introduced? The timelines are so important that you really, really need to understand these. And also, what impact is it going to have on yourselves as mortgage brokers? So a couple of things that you need to be aware of. This is HMRC's biggest change that they've ever made by doing tax made digital. So it's quite a big thing for them, really. So as you know, it's going to be making things more digital recorded. So gone are the paper that people are using in the past. They're going to have to start reporting quarterly to the HMRC. They're going to have to be looking at the types of compatible software, and this should help reduce any errors in tax. So hopefully HMRC will be able to move things along very, very swiftly. So it is quite a big initiative that they've actually done. So fingers crossed, let's hope it's going to work. Now, a little factoid for a morning for you is that when I did this research back in about May time, it said that HMRC were expecting 850,000 people to be applying to make tax digital. And when I put this presentation together, only 10% of people have actually applied. So it makes me think, oh my gosh, there's going to be a lot of people that are either going to be moving from sole trader to limited company, so they don't have to do it, or they are going to be in a bit of trouble later on. So as we know, making tax digital is already been put in force for VAT, so that's fine. A couple of areas that you need to be aware of is making tax digital is based on their income currently. So if they're self-employed and they've got £50,000 worth of income, then they will have to file their tax return this year. It goes down to 30,000 next year and 20,000 in 28. There are a lot of expansions for certain areas, which I'll talk about in a bit more detail. So these are the deadlines, really important because we're coming up to the 7th of August. This is the deadline that's going to be actually coming up. And basically, we need to make sure that people have actually filed. So it's for the period of the 1st of April to the 30th of June. They need to file it by the 7th of August. Now, one of the things you need to be aware of is there will be penalties involved for people who don't actually file. So I think they get like these point system, which could incur like a £200 penalty. I do believe that at the moment they're doing a bit of a grace period. So there's a soft landing period. So basically there shouldn't be any penalty for late filing for the quarterly updates. However, this period is going to be reducing to about 15 days for the second year onwards. So at the moment, they're giving people a little bit of leeway, but you need to be aware that there could be penalties that could incur, which could affect your particular clients. So I do believe there's some appeal process, but again, this is not my major area, but I just want you to be aware that obviously we know what the tax office is like, and so they do like to incur a penalty if people are not doing things on time. So who's going to be affected? So this is the bit that I think is really important that you need to be aware of. It's not everybody, because a lot of people think, oh, actually, I'm self-employed. And it's only when you break it down further do you think, well, actually, are you going to be affected? So the first 4 people on this list are the main ones: your self-employed applicants, your buy-to-let landlords, your portfolio landlords, and your sole traders. Partnerships is in a future phase, and also limited companies at the moment are outside that phase because they technically treat limited company directors as employed applicants. So if you've got a limited company landlord, then basically they're not going to need to file a tax made digital. However, if they own properties in their personal name, they will do. So I'm just going to give you a little example. Sorry if they're a little bit basic, but it's just going to show you which of your kind of clients would be affected. So let's look at a director. As I mentioned before, he's not going to be affected. So we've got John, who works at ABC Limited. He takes a salary through PAYE and he takes dividends from his company. He's got no rental income and he's got no sole trader business. So John, at this moment in time, will not need to apply for making tax digital. However, if we look at Sarah, she works for, she owns XYZ Limited. She receives a rental income from 2 buy-to-let properties where she's generating £40,000 worth of income. So although this year she won't need to actually become tax made digital, by next year she definitely will be. So it is just for your for clarity, it is just for sole traders, not company directors, and it will affect personally owned landlords and sole traders. So those are the main ones that are going to be affected on this one. So what are the key requirements? So as I said, everything's going digital. We like a little bit of computerism, shall we say. So it's going to be digital bookkeeping. Obviously, your clients are going to have to be familiar, which hopefully a lot of you might use this if you're self-employed anywhere, the softwares that are available. So things like Xero, QuickBooks, Free Agent and Sage, they're just a few that I'm aware of. These are the ones that will be the ones that will affect you. Can somebody go on mute? Because I can hear quite a lot of typing and it's a bit off-putting, sorry. So we've got month to date, as I mentioned, month to date compatible software. Also, you need to be aware that clients have to do a quarterly income and expenses, and then at the end of the year, they do a final declaration. So I do believe they've got the ability on the final declaration that if there were some expenses that weren't put into the quarterly ones, that they can then make that final declaration with all of their expenses that they actually need. So why should you care? How does this affect you guys when you're talking to clients? So it's really good for you because you're going to be a lot more aware of your client's financial position, what's actually happening to them. So you're going to be able to understand their business and their performances, their peaks and troughs. And instead of you relying on the old SA 302, you're now going to be able to see actually in the first quarter they did really well, but then there was a problem in the second quarter. It just gives you that ability to go, why was that? What actually happened with these fluctuations? Was there an error in any quarterly submissions? But it's something that the clients might have. Or have they got inconsistent bookkeeping? So this way you can sort of like keep a little bit more on top of what your clients are actually doing. And also it gives you a little bit more insight as to how you can help them in different ways. So this is partly my view of what's going to happen. I'm not going to say this is exactly what's going to happen with a lot of lenders or even how Kensington's stance is actually going to be. But currently, and from what I gather, I think until the first final quarter is actually being submitted, most lenders will go down the route of SA 302s and tax year overviews, as well as the accountant certificates and company accounts. Those at the moment seem to be the main ways that lenders are actually going to be looking at this information. But part of me thinks is, will lenders start to want to look at quarterly months, tax made digital data? And will it be acceptable? You could sort of like show somebody's got really good profitability. They might have the peaks and troughs, but at least you can demonstrate to a lender what's actually happening. Will this volatility affect how a lender assesses your case? All of these questions are all starting to come into play with people's policies at the moment. And will it affect our affordability models? Will they start to change on how we're going to look at self-employed? Because I think this is a lot of information that's going to be coming down the line that people are going to have access to. So it could have quite a big impact on mortgage applications going forwards. Now, these are just a couple of risks and red flags which I actually thought could cause alarm bells for us as a lender, but also for you as a broker when you're looking at clients' information. So we all know we have clients that leave things until the very last minute. You know, this could cause a bit of a risk or a red flag for you. Why they're leaving it all to the last minute? Is the record keeping a bit poor? If it is, you know, it's not going to help with mortgage applications, let's put it that way. The other thing is, and we see this a lot at the moment, people's banking is mixed with business and personal expenses, or even their record keeping could be doing like that. And they've got multiple income streams and they don't break it down very well. So again, it could impact on how somebody's business is actually working. But like I mentioned before, it's the large swings that we're seeing with that we can see probably with people's income. So again, all of these things are a little bit flags that you need to sort of like think about. The other hand is, like I mentioned before, tax penalties. It's going to be more visible. Is their tax incorrectly estimated? And how's this going to impact mortgage applications? Is it going to cause delays because of the errors that clients have actually made? So you being a little bit more aware of everything that's going on, you can help your clients with them. Obviously, there's loads of opportunities in this, so which is a good thing, because sometimes when HMRC make changes, that does affect our opportunities, but it gives you the opportunity to start talking to your clients earlier, so you've got a better picture of what their business is all about. You can build relationships with accountants. You can do more reviews with these clients, which is again really, really helpful for yourselves, because you can review other information apart from just their financials. It gives you a better preparation for any remortgages that are doing. And like I mentioned before, it gives you a lot more opportunities for you to look at. It helps you working with accountants, bookkeepers, and tax advisors. And also, I think it's a way for you to start looking at how you're going to process this information. What are you going to do? Are you going to change how you're doing your fact finds? Are you ready for making tax digital? Do you understand it? Do you know how to talk through it with your clients? Are you able to look at the financial data and understand their business a lot more? You can also probably help them confirm their tax position as well. And also it helps you to sort of like understand your client's business, so that when you come to a lender, you can understand how to package it a lot better, so that lender understands what's going on with your particular clients. Now, these are just a couple of practical questions. Sorry if some of it sounds like, yeah, I already do this, but I just thought I'd put it down just so that it's there. It's a question for you. Have you asked them, are they registered for making tax digital? If not, why not? And are they in the process of moving from sole trader to limited company so they don't have to actually do this? Or are they thinking of moving anything from sole name to limited company again? Is this going to, you know, buy to lets? Again, will this affect them as to why they're not making tax digital? Talk to them about what software they're using. Is it working for them? Have you got experience of a better one? Looking at their bookkeeping, their submissions, and if they've got any liabilities outstanding to HMRC. Have these income changed significantly for them? Now, a couple of other things to actually ask is, this was my tricky questions. What happens if this happens? What happens if that happens? And because I was a bit inquisitive, I thought I'd find out a little bit more. So what happens, one of the clients might come to you and go, what happens if my rental changes each year and I've got my ebbs and flows? Well, unfortunately, once you're in making tax digital, it's a bit hard to come out of, because you're in it for a 3-year period. So unless anything really, really changes, like you've sold all your properties or you haven't got your business anymore, can you then look to apply to come out of it? But otherwise, you're in that 3-year probationary period with them to see what's actually happening with your client's income. Is it going up or down? And obviously, as I mentioned before, we've seen that when if income does actually, as I showed you before, next year it goes down to 30,000, then it goes down to 20. So before you know it, everybody's going to have to be making tax digital. So unless there's a really, really big change, i.e. like they've sold all their buy-to-lets or they've closed their business down, that's the only time that they can go back to HMRC and say, sorry, I'm not doing this anymore. And then they can make that decision from there. The other question they might ask is, what happens if I own a property with somebody else? How's it assessed? So it's assessed on the individual, not the property itself. So obviously it means what's their qualifying income, and that's what they are actually going to be providing to HMRC. Now, this area I'm not big on, so forgive me if I'm not going to tell you all the correct information. But what happens if you've got a client who lives abroad? What happens there? So if they live abroad, then they still do have to comply if they fit that threshold, along with the non-resident landlord scheme that I'm not great about. But my understanding is that the agent deducts 20% of the tax from the rental income before paying you. So again, all of that information you might need to be a little bit more up to date with as to how HMRC are going to look at these types of clients. And then the other one is, what happens if I get income from a lodger? Again, I'm not a tax expert, but from what I actually gather, they do have a tax-free allowance for rent-a-room scheme. So for the first 7,500, I believe that's their tax-free allowance. So if, let's say, they earn £10,000 from a lodger, then they'll only be paying tax on the 2,500. So because of it subtracted the tax-free allowance of 7,500 from it. So again, like I said, I'm not a tax expert, but I just thought these are some tricky questions that may come up, and I was a bit intrigued into them, so I thought I'd find out a little bit more. So just going through a case study again, just to talk to you about, things to look out for that a lender might start asking you questions about. So let's say you've got a self-employed builder contractor. He earns £75,000 worth of income. He wants to apply for a residential mortgage, but you can see that his quarterly submissions is shown a decline in income. So at this point, you're going to want to ask him what's going on. Can you find out a little bit more, understand his business, maybe get some commentary from the accountant, and then from there you can consider what lenders are going to look at, what information. And then, as I always say to brokers, send them a little note, explain what's going on with the business, strengthen it up with what you understand about the business, because underwriters love to understand things. This way it stops them asking you loads of questions, because they've got a nice little story in front of them. They understand what's actually happening, and this way they can tailor their questions a little bit more better for you to get the information that's going to make them feel comfortable about underwriting a decision in this particular instance where your client's got a declining income. So what happens next? I always say you need to be prepared. You need to understand what's actually happening with Tax Made Digital. You need to educate your clients early. It helps you to build more relationships with accountants. So we're going to start seeing a lot better information coming from them. It'll also help you monitor a lot more of lending policy changes, what's happening with lenders, how they're going to be incorporating this. And again, finally, like I mentioned before, how are you incorporating it into your fact finds? Are you going to be asking the question up front, or are you going to be relying on your client to actually do it? Plus, if you've got relationships with accountants, it helps you to sort of like work with your client a little bit better, where you should be able to help them with your accountancy relationship that you've got. So just a couple of key takeaways that I wanted to run through. So like I mentioned before, it's the biggest change that HMRC have ever done. So, I think they're going to be pretty hot on it. Let's put it this way. It's going to affect a lot of your self-employed clients and landlords. Like I said, they reckon it was going to be 850,000 should be applying. So that's quite a big data, really. Um, this way you can help your mortgage applications run through so much more smoothly than they've ever done before. Helps with compliance because we're all going to understand underwriting issues and that sort of thing. And I just think finally you can help your clients, give them a lot more value when you're actually talking to your clients because you're aware of it. And like I know, a lot of you are probably self-employed, so you're probably already doing this because I know you mortgage brokers earn loads of money, so obviously you'll be doing your tax-made digital. So again, because of your familiarity with it all, it'll help you to be able to talk to your clients. Now I'm going to do my little final bit because obviously I can't just come on as Kensington and talk about something that's not relatable to Kensington. So, I mentioned earlier on, I'm quite surprised that because there's not that many people that have actually subscribed to Making Tax Digital, does that mean they're already talking to their accountants and making the move from sole trader to limited company? Now, with a lot of lenders, they don't like that. They're going to ask you normally to have them trading for 12 months in their limited company, but that is somewhere that Kensington can actually help these clients if they are making that move. Also, don't forget we can help clients who have been trading for 1 year. We can do that 85%. And if they've been trading for 2 years, we can go right up to 95% and work off their latest year's figures. We never, ever average at Kensington. If you've got somebody who is already a company director, don't forget that we can use salary and dividends. But if they're a 50% shareholder at least, then we can look at salary and net profits after tax. So again, it gives you those two options. I always say to people, don't send in both. Choose what you want to go with, salary and dividends or salary and net profits. If it's salary and dividends, please send in the SA 302 and tax year overview. If you want us to look at the net profits, then obviously send in the accounts along with the accountant's details so we can actually write to them. We will still currently want to see 3 months business bank statements, but again, with this involvement of tax made digital, there might be less ownership on looking at bank statements to see whether they're still reflective of the company's trading. Bit about why come to Kensington for buy to lets, because not only do we have we're in the top 5 for the best rates available, especially in limited company. We've got products that can offer your clients a much cheaper rate because your client might have a energy efficient A, B or C property, so they would qualify for our eco reward product. Look out for eco with a K, not with a C. It's not that we can't spell, it's just the K is for Kensington, I understand. So eco products will offer you a much lower rate than our standard products. We've got our prime range, which is for clients who are squeaky, squeaky clean, who will get the best affordability out there. And also don't forget that if you've got clients with a large portfolio, the way we stress portfolios is perfect coming to Kensington, because if you've got clients who've got property in a limited company and property in their sole names. Let's say the limited company is coming to us, we'll only stress the limited company and not the ones that are held in their personal name. So again, this can help your clients quite a lot. We have brought in some restrictions on the amount of properties that your landlord can actually hold, which is now 20 with a borrowing of 5 million. But also don't forget that if you've got a client who wants to come to us for a limited company buy to let, we can do up to 4 directors. We want the directors to own 100% of the A shares, and we can also do intercompany loans. And the best takeaway I can give you for coming to Kensington for a buy to let is we've got no maximum age. So if you've got an 80-year-old who wants to do a 25-year term, happy days. Kensington is the lender for you on that one. As I mentioned before, we can do lots of different things regarding criteria. We've got criteria for clients who may have had adverse in the last 24 months ago. We can help them with our buy-to-let criteria on that, as well as clients who want to come to us for HMOs and multi-units. And the good thing about coming to us now for HMOs is that Connells, our valuers, now will say whether a property is either readily available as a family dwelling, or if not, because it's been heavily converted, is there a demand for HMOs in the area? So this way, you've got the opportunity to get more of your cases through with Kensington. So I'm just going to leave you with a final little bit. It's a question, so I'm going to throw it out there, and hopefully some of you give me what your views are. How do you think lenders are going to be viewing these changes to Tax Made Digital? Do you think they're going to look more at how the performance of a business is, or do you think they're going to stick to what they know and just look at the SA 302, which is historic? So I'd welcome your answers, or I'd welcome your opinions on that. And if has anybody got any questions for me at all, please say yes. Silence is really golden here. I obviously explained it really well, or you've got no questions. Mohan, are you back at all?
Yeah, I'm here. I'm here.
Lovely.
Yeah, it doesn't look like there's any questions.
Yeah. Hopefully I covered off certain
Yeah.
requirements. You know, like I said, you probably are quite well aware of what's going on, but I just thought it was quite good to just highlight some of the areas that I think could catch a lot of people out, especially the penalties,
Definitely.
you know, whether should they be playing. And I just think August is just a really, really big deadline that's looming, and it's holiday season. Couldn't have picked a better time, really, could they?
Hey, that's right.
So yeah, obviously you've recorded this, Mohan. If you need any information, please let me know, and I'm happy to send it on to the team.
Yeah, send us any slides, and we'll send the recording to the advisors as well.
Excellent.
Great stuff. Thank you, Maria. That was really good and much appreciated.
Lovely. Thanks very much, Mohan. Take care,
Thank
everybody.
you.
See you
Thank
then.
you.
Bye-bye.
Bye-bye. Bye-bye.